Hello, everyone. Today on the final bar, my guest is Todd Sohn from Strategas in New York. We'll talk about the overall market conditions. S&P has been overbought for a while, really choppy the last two trading sessions here, Monday and Tuesday, really in wait and see mode as we wait for Fed week to play out for a lot of earnings, starting with Microsoft and Alphabet after the close today. As we're recording this, we're going to see where all the chips lie. But for now, let's focus on the long-term trends. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets, we focus on the charts, the visuals, we focus on what lessons we can learn from price, trend, momentum, breadth, sentiment, all the tools in the technical toolkit to try to make sense of a market in uncertain times. And, obviously a lot of potential catalysts this week. And I'm often asked, when you have the Fed meeting, when you have a ton of earnings, why would you even look at charts? Because it's not a technical thing, it's other things. I would argue it's always a technical thing because what the charts tell you is how people are anticipating some of these things, what the sentiment is, what the psychology of investors is leading up to some of these big events. And it also tells you how people are processing things. And if you want to understand what people are thinking about Tesla's earnings going into the announcement and coming out of it, the chart of Tesla, I would argue, is the best thing you can do to try to understand how investors are treating that stock before and after. So a lot of potential, catalysts this week. And as always, I would focus on the charts. When in doubt, lean into what's working, lean away from what's not working. In general, I think that's going to be a fairly decent approach to your investment process. We have great guests on the show. I'm excited to talk to Todd Sohn coming back on the show today from Strategas. He always brings some good charts to make you think, which is what I value most about his work. Tomorrow, we have Joe Duarte joining us. Joe's an options expert. He actually wrote Trading Options for Dummies. He's going to join giving his take on the current market. Next week, I'm really excited on Tuesday the 4th. One of my mentors early in my career, Jeff Weiss, a longtime strategist at Jessup and Lamont, now at Clearview Trading Advisors in New York. And then Wednesday, Sean McLaughlin from All-Star Charts. Sean was on our Options 101 panel a couple weeks ago. If you missed that, go to our on-demand network, StockChartsTV.com. You can catch that and the other educational sessions we have. Also, as a reminder, coming up Tuesday, May 4th, I'll be doing a special webcast called Sell in May, 5 charts you need to review. This is going to focus not only on the seasonal tendencies, the fact that the market tends to be weaker from May through October every year, but also just the message of the markets themselves leading into that and thinking about market cycles versus the actual evidence of the markets through price, breadth, and sentiment. So please join me if you can. Go to marketmisbehavior.com/sell-in-May to sign up for that free event. Let's continue on with our market recap. I do want to start quickly with a poll. We always have a poll going on our Stock Charts TV page, right on the Stock Charts website. Also on social media, we'll throw them around as well. I asked you over the weekend, when do you make time for a weekly chart review? 54% of you said Saturday morning, which is interesting, right? You close on Friday, have Friday night off, wake up Saturday morning, dig into the charts. I like that. I like the urgency. I like the commitment there. 25% of you said Sunday evening. 12% of you said Friday after the close. 9% of you essentially indicated you have no real weekly chart review process. So for those 9%, I hope if you take one thing away from the final bar, it is the importance of having a regular routine of reviewing the evidence. And if this show can be a part of that every day, that's great. I would encourage you, if you do nothing else, take the weekly wrap that we do on every Friday show. Take that as an inspiration to do your own process and dig deeper into some of the charts that are of importance to you. I don't know if there's a right answer to this, and I don't say there is. For me, I actually do mine starting Sunday evening and I finish Monday morning. But as long as you have a time that you dedicate to looking at the charts every week, looking at a consistent group of charts, I think overall you're going to be less surprised and more positioned for good outcomes. Let's continue on talking about our market recap. So as I mentioned yesterday and then again today, it's really a choppy environment. Now the market, opened lower and closed a little bit higher, but really was a wash. The S&P finished not far from where closed yesterday. This is really wait and see mode. And as we're recording this right after the close on Tuesday, we've got a number of companies reporting. This morning, we had some big ones, things like UPS, which had a nice surprise moving higher. And others today after the close, we have things like Microsoft, Google or Alphabet, Pinterest, Visa, AMD, Starbucks, FireEye, Enphase. These are all stocks we've been talking about many times over recent weeks and months. So it'd be very interesting to hear this. And again, the way I think of charts around earnings is looking at the charts leading up to that announcement, looking at how they react to things afterwards. So something like today, when I'm looking at the stocks that have gained the most in their scooter rankings, stocks that are up the most within the S&P 500. I'm seeing UPS in a sympathy move, something like FedEx, and obviously UPS up pretty good today. But that to me may be the surprise part of it. What should not be surprising is the fact that UPS has been in an uptrend. So for me, the real signal on UPS was back here a couple of weeks ago and actually broke above this congestion area, right? You have resistance around 175. You test it again in December. We break to a new swing high there, middle of this month. Today was a nice follow through to the upside. Don't get me wrong, that was nice. And whether or not that was expected, the fact that the path of least resistance was higher, hopefully was not unexpected to you if you're following the charts and focusing on stocks that are rotating higher. This is why when I screen regularly for stocks making new 3-month highs and stocks making new 3-month lows, it's meant to capture this sort of pattern, something that's been in a base, just starts to break out. That's where a lot of times the opportunity can be. And then the big catalyst, the big juice that causes something like UPS to move materially higher comes later. That, then you start to see, okay, this is why the stock is in a good uptrend. But overall, focus on the charts and focus on the signals of breakouts and breakdowns. Today, once again, we have the NASDAQ diverging a little bit from the Dow. Dow essentially flat as well. That was not super exciting of a day, but the NASDAQ sort of lower. So leading into this after the close, where we have a number of big technology companies reporting, overall some weakness going into there. Small caps, by the way, outperforming a little bit, up a lot more earlier today. This morning, it looked like small caps were just going to run away, continuing to push higher, came down to earth, but overall finished pretty strong. VIX around 1750. Real story here, I would argue, and we'll look at this chart here in a moment, 10-year yields actually going up pretty good, up above 1.6%. Again, we're going to look at that in a little bit. The TLT, which is what we usually use for bond prices, down about 0.9%. The dollar flat today. Commodities overall pretty positive, but precious metals mixed. You had gold going steadily lower. Silver actually finished positive today. So no real clear pattern with either of those. Cryptocurrencies, for the most part, moving higher. And if you want to see confidence that had eroded and now returned, look at the chart of Bitcoin going from 49,000 up to 55,000 in about a 48-hour period. So you saw that give back in cryptocurrencies over the weekend, especially Bitcoin down below 50,000, and look how it rotated right back higher and pushing up. So it's hard for me to not think of Bitcoin as a general risk off versus risk on signal, only because I feel like it's a big, it's a lot of speculation embedded into the price of a lot of cryptocurrencies. But again, worth noting the nice rise that we've had recently. Let's focus a little bit on interest rates here to start our discussion. So as I mentioned, the real the signal that we've talked about, or the pattern that we've seen with 10-year yields, has been a rotation higher in interest rates as the bond prices have come down. This is really starting the third quarter of last year, continuing on to the first quarter of this year. And at the end of March, it looked like rates were just going to continue higher to infinity, right? Never confuse the top of the page with resistance. We've seen a pullback here, which was not surprising given the bearish divergence in rate, or the bullish divergence in bond prices, with higher highs in rates, lower peaks in the momentum indicator. Now we've seen the 10-year yield come down to an ascending 50-day moving average. We've seen the RSI pull back to around 40. For me, that is sort of the ideal technical opportunity for rates to go higher. Also noting we're at the 38.2% retracement level. So this would make great poetry. This would be a poetic turn and very technically oriented if 10-year yields would bottom up right around here and then rotate higher to the next leg to the upside. It's interesting that we're seeing that in where we've had a number of financial stocks report in recent weeks. Now we're getting technology stocks and looking at how those two sectors perform going into earnings season, given some a pullback in rates, and then coming out, could we have a rotation back into the value trade away from the growth stocks that have been really, really hot over the last couple of weeks, right? Appreciating with things like Microsoft going to continuing to new all-time highs. That's a question I think a rise in rates could help us answer, where we might see leadership continuing on here in the second quarter of the year. Finishing off here, I just want to focus on some of the overall trends that we saw today. Interesting to see some energy, some E&P in the top 10 industry groups today. Also, hotel and lodging REITs and mortgage REITs were two of the top gaining industry groups today. And we talked about real estate on Friday's show into Monday's show, talking about the strength in the XLRE versus some other sectors, some of the better charts that have emerged in terms of just long-term uptrends. We highlighted these on the show yesterday, things like Simon Properties Group, SPG, CBRE. These are pretty good charts. They're in real estate, and the reason why I highlight when real estate's doing well, I find when people are screening or looking, they tend to ignore something like REITs because they're not as familiar with it. They don't think about it as much. And it's really worth paying attention to some of the signals there. Look for where the opportunities, not where you think they might be. Look to where the movements are. Look to where the opportunities are reflected on the charts themselves. That's the best opportunity for you. We need to take a quick commercial break. We'll be back with my guest, Todd Sohn. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. I'm your host, Dave Keller, here at StockCharts.com. It's so good to have you join us every weekday after the close for our show as we review the charts and signals of the day. As a reminder, we're going to do another mailbag segment a little later in today's show. We'll do another one at the end of this week, and we'd love to answer one of your questions on the air. Get your questions to us via email, thefinalbar@stockcharts.com, on Twitter @FinalBarSCTV, or on our YouTube channel. Just put a comment below the video that you're watching. And again, we'd love to hear from you. Any questions that are coming up in your own process of analyzing charts, looking at tickers, thinking of thematic trades, whatever it is that you're doing, let us help you along in your journey. Let us know what questions you have. Also, as a reminder, StockCharts TV on demand is available for you for free. Check it out. Go to StockChartsTV.com. Use your email, set up a free account. You can access all of our great content immediately. We're also on all the app stores. Just search for StockCharts TV on demand. I want to welcome on my guest, Todd Sohn. Todd is the technical analyst at Strategas Research Partners in New York. Todd has been a frequent guest on the show. Always brings a good long-term perspective. And what I think about Todd and the work at Strategas, the reports from Strategas always made me think. And for that, I was always very, very appreciative. Todd, welcome back to the show today.
Hey, Dave. Thanks for having me.
So we're starting, obviously, we have this condition where the S&P has been overbought recently. That's happened a couple times in the last year, but also in terms of breadth. Overall, breadth has been fairly robust with most stocks, an overwhelming number of stocks in a pretty good uptrend. Start us looking at breadth and tell us what you're seeing.
Yeah, as you mentioned, breadth is phenomenal right now. There are 95% or so S&P 500 stocks above their 200-day moving average right now. That's one of the best readings we've seen in 40 years worth of data. And so we always refer to that as good breadth by pullbacks because of the underlying strength. So we want to go back and look, what does that actually mean, right? Strong breadth. And so what we did on the scatter plot, and the x-axis is the percentage of stocks over 200-day. And on the y-axis is what the S&P does over the next 12 months from that data point. And the point being, when you are very overbought, like we are right now, your returns, while they may not be a home run like the 75% we saw the last year from the March lows, they're still very stable. They're more in line with the historical averages. Expect, say, something in the high single digits to low double digits, right? The dispersion of very overbought conditions is very tight. We should continue to say buy pullbacks, but just expect pretty decent returns, not overwhelming returns. On the other side of that, when you're very oversold, right, when there's a minimal amount of stocks over 200-day average, your returns are just all over the place. The dispersion is everywhere. You can hit a home run like you did last year off of the March 2020 lows, or it can be a complete miss. So overbought conditions are much firmer. But that's the type of environment we want to be in for more stable returns going forward. The path there may be tricky, but stay the course here with these breadth readings.
Interesting. So overall, signal is as you suggested, right? It's good overbought, which suggests market strength, and it looks like a narrow spread of returns, but overall net positive, as opposed to when things are super oversold. Now, the question then is obviously leadership and where to be leaning here. Here we're looking at consumer staples. Talk us through this one.
Yeah, what's most interesting, and I think we have to pay attention to over the next few months, is what does leadership look like? We've been used to this risk-on, risk-seeking environment for the better part of the last 12 months. And we think that's going to continue. Right here's consumer staples relative to the S&P 500 on an equal weight basis on the bottom panel of this chart. It hit new lows today. Defensive groups just are not participating here. The market might be a pinch tired given the run it's had, but you're just not seeing any sort of bid for defensives. Discretionary is still outperforming staples. High beta stocks are generally still in control here. So we like that. And what's also notable about the staples chart is that you would think if bond yields, which I know you were just talking about, were to come in further, you would have saw more strength out of staples, and that just hasn't been the case. So to us, that says A, risk on, risk-seeking leadership going forward, for at least for now, and B, expect bond yields to continue to resume higher after this little brief pause they had.
It's a great take, Todd. And just one question here, because I have a little bit of time left. When you're thinking about the weakness in consumer staples, it seems really clear. And I was taught, right, if you want to outperform the index, don't own things that are underperforming the index. So staples certainly don't seem to be a great opportunity here. So where are you seeing the opportunities? Is it something like, things like Microsoft, Alphabet, and others that have just been resilient leading up to this week? Or is there more things that have had that actionable pullback, things like financials, energy, and others that have pulled back? Where are you looking opportunistically now for the coming months?
I think there's a few groups. The home builders have been excellent, and despite the jump in rates, those are great long-term charts. I think financials are still in firm shape, perhaps a little bit extended. They may need to pause for a little bit more, but they're absolutely worth a look. And then energy is perhaps the most interesting of the three, because that is a group that has corrected already. We think they're oversold. And if they are the real deal here, a change in regime that we've haven't seen in years, they'll start to respond here. I think are worth at least a tactical shot. The tech names are still good trends. They're just not the leadership they were, over the last couple of years, which I think is something worth keeping in mind. It's a 2013 type of scenario where tech rose with the broader market, but they actually underperformed a lot of the other cyclical sectors.
Yeah, it's interesting when you look at a chart of Microsoft. It's a decent chart, but the relative strength is not super impressive compared to something like home builders you mentioned, which is actually breaking out pretty nicely to the upside. When you're thinking of looking at the next couple weeks as we kind of navigate through earnings season, and we have the Fed coming out, what are sort of the can you give us a quick sense of what's your risk assessment? What would you see that would tell you things are not as attractive as they may have appeared? Is it a rotation higher in something like consumer staples that would be unexpected, or is it more a particular level on the S&P where if it hits this, it tells you things are starting to get rockier? Like what would you see that would tell you things are less attractive than they appear at this time?
I would keep an eye on discretionary versus staples, particularly in equally weighted construction. That's been a great indicator, especially over the last 12 months. I'd keep an eye on high beta versus low beta stocks, because that's the low beta lever can be more defensive. I'd keep an eye on copper versus gold. Copper's been great, and that's a ratio that's been resuming higher, and it's consistent with higher rates too. I think those three barometers, if you start to see them roll over, you'll likely see it eventually hit the S&P. I think there's decent support when the 4,000 area was the last breakout area. So I would guess if those three indicators rolled over, you'd see the S&P break that level too, and perhaps a change of tune.
That's a fantastic take. Appreciate you sharing some charts, taking my questions as well. Stay safe, be well, and we'll talk to you again soon.
You too, Dave. Thanks a lot.
That's Todd Sohn. Todd's at Strategas Research Partners in New York. And again, what I love about his work is that first chart, looking at the scatter plot, looking at what the market actually does given breadth conditions, very positive or very negative. Those sorts of charts are the types of things that Todd brings with them that just make me think and question where we're at. I tend to look at breakouts skeptically, which is, I'm sure you can pick up on that voice when I'm looking at the markets and I'm seeing things go higher and I'm seeing things overbought. I start to look for chinks in the armor and where there may be signals of negativity. A chart like that reminds you that overall we're in pretty decent shape here, especially given the strength in breadth conditions. We need to continue on answering your questions from the final bar mailbags. Let's open it up. We'll get through as many as we can. Let's start it off. Number one, I use seasonality as one of my methods of investing. I don't recall you spending time on the subject, and if I'm correct, why not? Also, StockCharts only goes back around 5 years. Do you know how to expand the time factor for, say, 10 or 15 years? Really, really good question. We're going to bring up the XLF, and I'm going to switch to seasonality. And I'm doing this so if you don't know how to get to it, click up here where it usually says sharp chart, and you go down to seasonality. Type in the ticker and then hit enter. And what you can do also is you can make this a relative strength look. So if you type in like SPY, it would give you the relative performance and looking at the performance of that ratio going through these times. So what this is simply showing you a batting average for these months going back for the last 5 years. What percent of the time is the ticker that you brought up, is the XLF closing higher than it did at the beginning of each of those months. You mentioned the 5-year limitation, and all you need to do is go to the bottom here and drag this back. We'll go back to 20 years, and that's where you can. That's as far back as we store the data for the seasonality chart. So at the bottom, it'll start with 5 years. Drag that left side of it back to 20, and you can get the further indication. When people talk about sell in May and go away, when they talk about the Santa Claus rally, the January effect, all of those things, this is the chart I would bring up to try to make some analysis of that. And overall, what you can see from something like financials, the fourth quarter tends to be the strongest in terms of the average returns. In general, you're better. It tends to be weaker in the first quarter, strongest in the fourth quarter. If you do this on the SPY, if you do it on other sectors, on relative strength, you can start to draw some really cool conclusions of it. As to why do I not spend time on it, that's a really good question. I do a little bit. For me, cycles have always been an interesting phenomenon. I've tended to focus less on cycles and more the evidence of the markets themselves. So if the cycle tells me that it's a weak time to own financials, but the chart is telling me to own financials, I am 100% of the time going to go with the chart and not the seasonality. And that's why I probably don't bring it up as much. However, I tell you what, I usually have subscribed to services or talked with analysts that are big on seasonality, and people like GAN strategists and others who focus on the time and price relationship, I've always found very, very interesting because they have more of a cyclical part of their analysis. Mark Newton, by the way, from Newton Advisors, comes to mind as someone who incorporates some of these seasonality tendencies into their work that I appreciate. Next question. I'm not a huge TA guy, and it's fine, nobody's perfect, but is this not the biggest cup and handle forming for GLD than you've ever seen? I love the absoluteness of that, the resolve with that statement. Is this not the biggest? Are you not entertained by this huge base? Let's look at the weekly chart here. We'll take a look at what we're talking about. Yes, you're actually, let's go back a little bit further. You're actually looking at this chart here and saying, isn't this a huge cup and handle pattern, right? The rally in the late single digits, early teens, the peak that we saw in 2011, this big rounded bottom facing another high and then a pullback. I'm going to look at $ gold. And you'll see a very similar pattern. So is this a huge cup and handle pattern? Potentially. Here's what you need to remember about a cup and handle pattern. Number one, absolutely right. That is certainly how you could describe this, the big rounded bottom after a big rally, and then we've rallied up to there. Cup and handle patterns by definition are best when the rim is at an equal level. So this is a less ideal cup and handle, but I would argue going back about 10 years, I'm okay having a little bit of wiggle room on where that resistance level is. I think that's fine. The other thing to remember is it's not really a valid pattern until you break out to the upside, right? So a lot of times we prematurely like to assign something a pattern. It's like a head and shoulders top before it breaks the neckline. You really can't technically call it a head and shoulders top until the neckline is broken, until that signal occurs. So until we break above the rim, above the rim of the cup, you can't technically call it a cup and handle top or cup and handle breakout. You could call it a cup and handle like pattern. Technically, is how we would you'd be allowed to do it. So gold getting above 2100 would signal a vastly superior outlook for gold than we've seen for quite a while. And so my short answer is absolutely right. My longer answer is be careful about prematurely calling something a very bullish pattern until you get the validation, the qualification. Final question, most likely. Great show. Question for the mailbag. What do you think about adding volume profile to sharp charts? Yeah, it's a really good question. So, a lot of times we'll look at volume distributions as a way of, thinking about the performance of different stocks over time. And we had a question earlier. I think this was on Friday's show. We had a question about what was it called? Market profile, right? Which is Pete Stottlemyre's creation, which is really a play on looking at volume distributions, right? It's looking at a price distribution and how much time the price has spent at different levels. At times in my career, I have used that a great deal and focused on price distributions. And Robin Mesh, who actually wrote a chapter for my book that was published a long time ago. In 2007, she wrote a part of the chapter on the book focusing on price distributions using market profile. We do have on sharp charts what's called volume by price, and I don't know if that's exactly what you're looking at, but I think you should check it out. If you go to the overlays section and go to volume by price, it's going to show you this, which is basically looking at the volume that is spent in these different buckets of price level. It's a really cool way to look at the relationship of the price trend and breakouts and breakdowns versus where we've spent time and where we've put in a lot of volume, because ideally those are areas of congestion, right? Areas where we've spent a good amount of time, put in a good amount of volume, and more often than not, those tend to be important levels for the stock. So if that's not exactly what you're looking for, let me know, and I'll try to point you more in the right direction. It's all the time we have for the mailbag. Thanks as always for sending in those questions. Keep them coming. The final bar at StockCharts.com, and hopefully we can answer your question on Friday's show. We need to wrap this show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is looking at the S&P and looking at the new highs and new lows. This is the 52-week highs and lows. The 52-week highs are in green. The 52-week lows you may not notice at all recently, but they're there. And those are stocks making new 52-week lows. We've essentially had zero in the S&P since last October, right? Most of the S&P is in a fairly decent shape and off of its long-term lows. The blue arrows here, I think, represent the story. Todd Sohn was telling us about the strength in the market in terms of stocks above their 200-day moving averages. I would add to that the expansion in new highs. Healthy bull markets have expanding new highs where more and more stocks are not just in uptrends, but making new 52-week highs. We've seen a steady increase of that. And most recently, this is on Friday's session, about 23% of the S&P making a new, that's actually more. That's about 20% of the S&P making a new 52-week high. That's not bad, right? That's a good number in an uptrend. So that continuing to go higher, those lines, not just on the S&P, but for the NYSE, I think is overall a very constructive sign for long-term strength in stocks. Chart number 2 is the 10-year yield. We spent a little bit of time earlier talking about rates that had pulled back. I think technically we're heading, to a period of higher rates. We've talked about that, but I think we may have seen the pullback complete going to the 50-day moving average. What will be very interesting for me to watch is this ratio, which is the ratio of the financial sector, the XLF, versus the technology sector, the XLK. Now, I am playing with fire because we're in the middle of when tech companies are reporting earnings, which means you can have violent swings in those stocks. However, notice the underperformance, multi-year underperformance of financials versus tech. Look how that changed at the September market low, and we've pulled back a little bit as rates have pulled back. I would not be surprised to see this ratio rotate higher from here. Finally, I thought Todd Sohn's take was very well done. In particular, he mentioned at the end the ratio of consumer discretionary versus consumer staples, in particular the equal weighted version. That's the series here at the bottom. The top is the cap weighted performance, looking at the XLY versus the XLP. Here we're looking at the equal weighted version, which made a new 52-week high today. So it is clear a signal of offense over defense. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. And a special thank you to Todd Sohn from Strategas joining us today, sharing his thoughts on the equity markets. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.